Friday afternoon, the wire clears. The number on the brokerage account has 6 zeros now, where it used to have 5. Monday morning, the mother calls. Tuesday morning, the brother. By Friday of the second week, 3 calls have to be made. And those 3 calls, more than the 7 years of work that produced the wire, will set the cadence for the next 20 years. What does the day after look like, when the day before was a normal Wednesday, and the day after is the day you first read your own name above a 7-figure balance? That's the part of the first million story nobody films. The path to the million is on every channel in the space. Savings rate, S&P 500, time in the market, pre-enumerated levels of net worth. The first 24 months after the million is on almost none of them. In the data we have on first-generation wealth holders, from Northwestern Mutual's Planning and Progress Study, from UBS's Global Family Office Report, from the long-term Spectrum Group Affluent Investor Research, points in the same direction. The threshold is the start of the test, not the end of it. What I want you to do while you watch is hold yourself somewhere on this arc. Maybe you crossed the threshold last quarter. Maybe you're projecting forward to the year you expect to cross it. Maybe you watched a friend or sibling or cousin cross it 3 years ago and you're still working out what you saw. Wherever you are, the question for the next 16 minutes is the same one. Which of the 5 phases looks most like the trajectory you're either on or watching from outside? Today's video walks the standard 24-month arc that follows the wire. 5 phases. Family financial requests at 1 to 3 months. Lifestyle inflation at 4 to 8. The first advisor meeting at 9 to 12. The identity shift at 13 to 18. And the call at 19 to 24. The call that wouldn't have been considered in month 2 that gets considered and often made in month 22. By the end, you'll see why the wealth management industry treats first-generation clients differently from inherited wealth clients in the first consultation. And you'll see which products specifically get put on the table for one group and not the other. Phase 1. Months 1 through 3. The first calls are family calls. Mother needs help with the property taxes on the house she's lived in for 30 years. Brother is between jobs. Sister has a kid going into college. Within 90 days of the wire clearing, the typical first-generation millionaire fields requests in the range of $40,000 to $200,000 from the immediate family circle. Each request is reasonable. Each request comes with a story that's hard to argue with. If you just crossed a threshold and your mother called you about her property tax bill, what would you do? Most people watching, if you're being honest, would write the check. That's not a flaw in your character. That's the default position the prior baseline trained you for. The Federal Reserve Survey of Consumer Finances doesn't directly track post-threshold family transfers in a single line item, but adjacent research from the family wealth literature points to the family circle ask being the single most fielded financial interaction in the first quarter after the wire. The pattern: the protagonist responds to most or all of the requests. The amounts are written without documentation, without a schedule, without a replacement plan, without tax accounting. The annual gift exemption, $17,000 per recipient in 2023, $18,000 in 2024, sits unfiled. No tax is owed in most cases because nobody is near the federal lifetime exemption ceiling, but the form that should have been filed isn't filed, and the running internal record of who got what when isn't kept. Work it backward. The math from phase 1 alone is rarely fatal. $40,000 to $150,000 dispersed across family members over 90 days isn't going to take the protagonist back below the threshold. What phase 1 sets is the cadence of I have the money, you have the need, the transfer happens. That cadence persists into phases 2 through 5, and once it sets, your phase 3 advisor can't undo it for you. Phase 2, months 4 through 8, the slow one. Same mechanism as the post-inheritance dynamic in adjacent research, with one difference. The first-generation millionaire is still earning. Income hasn't dropped, so the slow drift in monthly spending feels less alarming. The income covers the new baseline. Better restaurants, $300 a month. A car upgrade, financed, $400 a month additional. House upgrades on the property the protagonist already owned. A trip the protagonist wouldn't have taken 3 years ago. None of it feels expensive at the time. Each month, $2,000 to $3,000 goes out the door that wouldn't have gone out the door in the prior baseline. Over 5 months, that's roughly $12,000 to $15,000 absorbed into the new lifestyle floor. Have you ever noticed your monthly spending drift after a raise? 300 here, 400 there, none of it singled out as a decision? The mechanism is the same. The difference at the threshold is the scale and the silence. The mechanism is the same. Hedonic adaptation described in Brickman, Coates, and Janov Bowman's 1970s foundational work and refined in Killingsworth's recent income and well-being research. The new baseline becomes the floor. The floor becomes invisible. The difference for first-generation millionaires, because income is still arriving, the floor doesn't trigger the alarm that the same drift triggers in the inherited wealth context. The protagonist can absorb the lift without watching the principal balance move on the monthly statement. The principal balance does move, but the monthly statement doesn't make the move visible at the spending decision level. Phase 3. Months 9 through 12, the first advisor meeting. This is the phase where the industry's first generation versus inherited wealth differential becomes visible, and this is the ex-insider observation that the wealth management industry doesn't print on its website but operates from internally. Why would the product menu in a first consultation be different for two clients with the same balance? You'd assume the menu tracks the balance. It doesn't. It tracks the source. If the protagonist walks into the first consultation as a first-generation wealth holder, meaning the money was earned through career, business sale, or accumulated savings rather than received as inheritance, the advisor's product menu in the first meeting tends toward a specific set of instruments: annuities, indexed universal life insurance, whole life insurance with a cash value component, structured products with downside protection, sometimes a buffered exchange-traded fund. If the same person walks in with the same balance, but the money came from an inheritance, the product menu tends to look different. The opening conversation tends to focus on portfolio construction, asset allocation across diversified equity and fixed income, tax loss harvesting, and estate planning structures. The structural reason, the industry observes that first-generation wealth holders are statistically more receptive to guarantee products because the prior baseline included scarcity. The memory of not having the money creates demand for protective wrappers. Inherited wealth holders who don't share that memory refuse the same products at significantly higher rates. LIMRA, the Insurance and Financial Services Industry Research Association, reports that total US individual annuity sales reached a record $385 billion in 2023. A meaningful share of that flow originates in early advisor relationships with first-generation wealth holders. The annuity isn't a fraud, it's a real product with real use cases, including guaranteed income in retirement, longevity protection, and principal protection in volatile markets. But its placement in your first consultation as a 30-something first-generation millionaire with 30-plus years of compounding still ahead is structurally distinct from its placement in a first consultation with a similar balanced inherited wealth holder. The industry has internal data on which client profile receives which product menu in the first consultation. The difference isn't accidental. It's the priced output of 40 years of behavioral observation on which clients accept which products and at what take rate. As a first-generation client, you signal receptivity to guarantees in the first 3 minutes of the conversation. The advisor, particularly a commission-compensated advisor, less so a fee-only fiduciary, reads the signal and offers the matching product. Would you catch the signal you're giving? Most first-generation clients don't. The signal is precognitive, relief at the word guarantee written on the proposal, and the meeting is over before the conscious mind reviews it. If you've stayed with this so far, the channel already knows something about you. You're running the long sum. Subscribing here is just the marker that you're in the same room as the count. Not loud about it, just present. Phase 4, months 13 through 18, the identity shift. By this point, the protagonist has been the first millionaire in the family for over a year. The early calls have been fielded, the lifestyle has lifted, 1 or 2 advisor products have been placed. The conversations the protagonist has at work, at family gatherings, at the gym, at the coffee shop have started to bend. The shift is subtle. Work it backwards 6 months and the protagonist would have said, "I made some money, but I'm the same person." Roll the calendar forward 6 months and the protagonist starts saying la 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 out loud or just internally, Mehmed la, I'm at a different level now. The Spectrum Group Affluent Investor Research, long term, finds that first generation affluent individuals are more likely than multi generational affluent peers to engage in visible consumption signaling in the first 3 to 5 years following the threshold. A nicer car, a better watch, a more visible address. The signal isn't about the goods themselves. Mehmed la, the goods are downstream. The signal is the externalization of the identity shift. The protagonist is, internally and externally, becoming someone who deserves to be wealthy. That's the number that makes the difference at this phase. Mehmed la, not the dollar number on the statement, the identity marker count on the day-to-day signal layer. Watch how this works. The identity shift isn't bad in itself. The risk is that the identity shift starts to license calls that the old identity would have refused. Phase 5, months 19 through 24. The phase where the consequential move appears. By month 22, the protagonist has been wealthy for almost 2 years. The cadence of family request is settled, the lifestyle baseline is settled, the advisor relationship is settled, the internal frame of I'm at a different level now is settled. Then the offer presents. It varies case to case. Sometimes it's a private investment opportunity from a friend or former colleague. Ground floor, friends and family round, you're exactly the right fit. Sometimes it's a vacation home in a market the protagonist has been told is appreciating. Sometimes it's rolling capital into a business venture the protagonist wanted to start in their 20s and now has the means to launch. Sometimes it's buying out a partner in an existing arrangement. Sometimes it's a significant gift commitment. Number one, a wedding, a down payment, a multi-year tuition pledge. Which one would land for you? If you've made it this far in the video, you can probably name your own version. Most viewers can. It's the move you've been quietly waiting for the means to make for a decade. The threshold gave you the means. The threshold did not give you the cadence to evaluate it. In each of these cases, the move would have been refused in month 2. The protagonist in month 2 still carried the prior decision frame. I just hit this threshold. I don't yet know what the cadence looks like. I'm not going to commit at this scale. In month 22, the protagonist carries a different frame. I've been at this level for 2 years. I know who I am now. This is a reasonable move for someone at my level to make. The mechanism is identity as license. The shift from I made a million to I am wealthy is the structural license for the move. Open your account right now, you'll see it. The move isn't intrinsically wrong, it's structurally premature, taken before the framework was installed. Without the framework that should have been installed in phase 3 through fee-only fiduciary advice, not the commission-compensated product menu that actually got placed, the move is being made on identity confidence, not on portfolio architecture. That's the move that determines whether the next 20 years look like a continuation of the threshold or a slow return to your prior baseline. Friday afternoon, the wire clears. Monday morning, the mother calls. Tuesday morning, the brother. By Friday of the second week, 3 requests have to be answered. By month 24, dozens. By the end of the first 24 months, the cadence of how you make calls, if you cross this threshold, has either been structured through fee-only fiduciary advice engaged before phase 3, through 90 days of stillness immediately after the wire, through an actual framework installed before any major action, or it has been left to default. The Northwestern Mutual and UBS findings, summarized across multiple recent reports, point to the same structural pattern. The spread between first-generation wealth holders who engage fiduciary advice before the first 90 days post-threshold and those who don't is one of the largest predictors of where the wealth sits at year 5. The industry is aware of the pattern and will sometimes name it for you on the first slide of a pitch deck, but more often the industry sells you the annuity in month 9 and lets the identity shift land in month 15 and watches the move land in month 22. The move that mattered again was the move that wasn't made. The choice to sit with the threshold for 90 days, install the framework before deploying anything, and only then begin. That move doesn't feel like a move. The industry doesn't sell it, family doesn't ask for it, nobody walks in unprompted and recommends it to you, which is the structural source of the 24-month arc this video just walked. If this 24-month arc landed, like the video, subscribe. Tell me in the comments which of the 5 phases looks most familiar from your own observation or from someone you know who crossed the threshold. Net sum keeps the count going.